myself. My name is Danae Aballi. I'm a real estate agent here in Orange County, and I've got an awesome panel for you guys. I wanted to share Prop 19 and how it affects both real estate, which is my business, but also your estate planning, because the new Prop 19 does have some pros and some cons. It's also what we're calling today the good, the bad, and the ugly. So we're going to dive into that. But just to kick things off, I introduced myself. I would like our other panelists to introduce themselves as well. Ken, why don't you start? Ken is our CPA, and welcome, Ken.
Yeah, thank you, Danae. Yeah, my name's Ken Cathcart. I'm a CPA, tax partner at JLK Rosenberger, specializes in real estate transactions, family businesses, and the like. I've done a little bit of research on Prop 19, and I was going to present some of the highlights, pros, cons, pitfalls, or what I call the good, the bad, and the ugly.
Thank you. Yeah, Ken's got the majority of the presentation today, just because it does affect certainly our taxes. But Kay, would you please introduce yourself as well?
Sure. Thank you, Danae, for having us today.
Yeah.
I'm an estate planning attorney, and my focus is on helping people navigate through the process of planning for the many uncertainties of our future. I'm here because I believe that education is the basis of making good decisions, and Proposition 19 will affect many of you and your future planning and house buying decisions. So thank you for letting me join.
Yeah, absolutely. And not last but not least, that's what I'm trying to say, is Jaril. So if you could introduce yourself as well. It's the four of us that put this event on for you. So Jaril, can you tell us about your business?
Welcome everyone. I'm Jaril, Tudio, insurance consultant here at Spinnaker Investment Group. And I partner up with your estate planning attorney and accountant on these type of things. So I wanted to make sure that we put together this great webinar and informational Zoom for you guys.
Absolutely. Well, one last thing, and then we'll turn it over to Ken so he can talk to us about Prop 19. I will tell you there's no sales pitch whatsoever in this webinar. It's just good content. As professionals, we know that if we provide good value and good content, if you like us, you're welcome to call us. So any and all of us, the four of us on the panel, welcome your business and phone calls. So if we can help down the road, make sure you reach out to us. But with that, let's get Ken's presentation on the screen, and we'll jump right into it. Lots of moving parts in Prop 19. One moment here. Okay, bear with me. All right. So Ken, why don't you walk us through Prop 19?
Okay, as I was previously mentioning, there's some good parts and bad parts and ugly parts of this Proposition 19. So let's start with the good. Do the next slide. And the good parts about this is we currently have our current law right now at age 55 and older. As you may or may not know, you can transfer your property tax base to a new property if it's equal to or less in value. And but it's a limited transfer. It's limited to certain counties, and I've listed these counties that are available, what we call reciprocity with respect to those rules. And that's been in the law for some time. But here we have this change that was voted in, Proposition 19, and it changes these rules and in a lot of ways for the better when it comes to this particular issue. And so Prop 19 expands the applicability of being able to transfer property to not only being age 55 and older, but also if you were severely disabled or a victim of a natural disaster. It relates to your primary residential property tax base. It can be transferred to a new home, but the important thing is now you can go anywhere in the state. It's statewide, and the value that can be transferred is no longer limited to just the sales price of your old home or less. You can actually trade up in value. And so if you wanted to, let's say your kids have moved out of out of the house and you're an empty nester and you're moving to the beach, well, you may take a smaller home, but it might be more in value. And so that could be an opportunity for you, that you can transfer your property tax base from your home that you may have owned for 20, 30 years into a beach house. So when you do transfer your property tax base for more value, meaning trading up on a home price, you will have a slight bump, but the bump will only be the increase in the value. So I have a little example I want to go through on the next slide, kind of illustrate this point. So let's just assume that a parent, might sell their property for 1.8 million, but let's say they bought it, or they have a property tax base of 800,000, and they're looking to buy a home for $2 million. Okay, and so the question here is, under the Prop 19, what would be their new property tax base? And the way the math works on this is you take your old base of your old property, in their case, $800,000, and you look at the incremental increase between the fair market value of the new property you're acquiring and the fair market value of the old property that you sold. So, and that increase will be subject to additional property taxes, but it's just the increase. And so in this case, we'd have the 800,000 trading into a $2 million property. Our new property tax base would be $1 million.
Yeah. Well, Ken, if you don't mind, I'll jump in just to say,
Sure.
From the real estate agent perspective. So what we're seeing, or what I'm seeing as an agent, is a lot of times you have this $1 million home, but the homeowner is currently paying as if the home is only worth, let's say, 200,000 or 300,000, and that's because of California's Prop 13, which only increases your tax bill by 2% every year. So many of the customers that I talk with, they don't want to lose that very low tax bill. And this is a way of taking that low tax bill with you. And I think if you're on this presentation, you're probably a homeowner and aware of that Prop 13, but I just wanted to not leave anybody behind, so everyone understands that's what we're talking about, is that kind of low property tax base. You can take it with you, and that's whether you move from Newport Beach up to San Francisco, or that's whether you move from $1 million house to a 200,000 in Palm Springs, or up to a 5 million on the beach if you want to go that route. So just opens up a lot of freedom, since we're on the good side of the Prop 19, total freedom to move where you want and take that tax base with you. So hope that helps.
Great, thanks, Danae.
Yeah.
All right, and so there also is what I'm referring to as the bad of Prop 19, and this is where, under our current law, we could transfer our principal residence to our children with really no limitations, and in addition to that, we could transfer up to $1 million of property tax base to our children, and a married couple effectively could transfer $2 million, $1 million each. And so what Prop 19 is, and when the ballots came out, I mean, I never heard really much talk about this side of Proposition 19 on the radio, or but so I started getting calls from clients going, "Hey, what's going on with this Prop 19?" And anyway, after it got passed, starting to panic with these this particular issue. And so the issue is they've completely removed the ability to transfer investment property to your children, and preserve the low property tax base. So, which was always a great tool to have. And when we did estate planning, we always tried to manage that we protected as much of the property tax base as we could whenever we transferred real estate. Well, now that issue's kind of been thrown out the window, except with respect to the principal residence. And so in our case here, the principal residence can continue to be transferred to your child, plus up to $1 million of appraised value. And so, I mean, that's still there, but the key is the child has to live in that residence. And so that may not always be practical if you have multiple children, and there's a lot of unknown areas here that I think are trying to be worked out. All right, then the next slide. And I have an example of this.
Great.
So in this example, we're going to assume that the parents own a home. It's got a market value of $2 million again, and a property tax basis of $800,000. Now, they both pass away, and their child inherits the property. So the question is, what are the property tax issues, whether the child lives in the home or the child rents out the home, meaning holds it for investment purposes? And so under our scenario where the child lives in the home, its property tax base under the old law would be $800,000. It would continue to carry over. But under our facts here, we have a $2 million property. And so its new adjusted property tax base is $1 million. And the way you get there is essentially taking the parent's property tax base plus the $1 million of that parent-child exception that's available under the Prop 19, and comparing that to the market value. And since we have a $200,000 market value bump to get to the $2 million property, we're left with a $200,000 adjustment to the original parent's base of 800 or $1 million in property tax base. So I've used, just to simplify the math, a 1% real estate tax rate here to show that under that scenario, their parents probably were paying $8,000 annually for property taxes. Well, now the children are going to pay $10,000 in this example to transfer a $2 million property. If the child does not move into the house, this is where the bad really kicks in. And so there is no parent-child exception anymore. And therefore, the property taxes are reassessed at the full $2 million value. And so almost doubling the property tax rate annually, or property taxes that are assessed annually. So you can see that's a significant increase in property taxes. And depending on the facts of the family, this could be detrimental to where they may have always wanted to keep this home held as an investment property, and maybe they can no longer afford it with the increased property taxes. So that could be a real life situation.
Ken, I do have one question, and I believe it relates to this slide, but it may even relate to the first slide. But someone's asking, why isn't the tax basis 1.2 million? And I do see the 1.2 million on your screen, or on the slide rather.
Yeah. So I tried to set this up in a format of where I was comparing child lives in the home, child that rents out the home from a mathematical type example. So you actually look at what I have is line A and line C, and the two of those added together is what gives you your new property tax base. So when the child lives in the home, they're going to get the parents 800, plus they're going to get the increase. They're going to be charged property taxes on the increase in the property value in excess of $1 million. So in our case, they get $1.8 million of available property tax base to be transferred. But since the property is $2 million, they have a $200,000 adjustment. On the second scenario, we don't have that extra million. So it's automatically going to be the fair value of the property. So I just wanted to keep the math working the same way. It would be again, line A plus line C, which effectively equals the $2 million of what the value the home was worth.
Well, Ken, thank you for that. I do have one more question, and feel free to say you want to hold it to the end, but specifically on this screen, how does it work if the children inherit multiple rental properties?
Well, it would be the same, just multiplied by the multiple rental properties, unless somebody wants to live in one of those properties, right? And And
Okay.
by the way, they would have had to been the parent's principal residence. It just can't go from a rental property to a principal residence. So,
Got it.
all right. So we've come up with kind of a possible solution to this to some degree to preserve the parent's property tax base for the child's life. So that would mean that it would delay the reassessment under this scenario until the children or the child passed away after they inherited the property. And so an idea, a planning strategy, if you will, would be to take this, and I'm calling investment real estate, but it could also be the parent's residence, knowing that no children are ever going to live in that home, could be substituted in for investment real estate. So in other words, you're going to convert the parent's home to a rental property after they would have passed. But so what we would do while everyone's alive, right, is we would have the parent transfer essentially a 51% interest in that investment real estate, okay, to the children or to a child, just to make it the example simple. And so they transfer the 51%, which means they're retaining 49% of the ownership of that property. And so that transfer needs to occur before February 16th to qualify for the parent-child exclusion. But you get to have, so now you'll be able to transfer the parent's property tax base over to the child, because the trigger for reassessment is always a greater than 50% transfer. And so since we've got 51% or greater than 50, we're going to have a full reassessment of the value of the property. So, and so since we have a full reassessment, we change the parent-child exclusion to essentially carry over the parent's property tax base up to the $1 million limitations. So that effectively will now preserve the value, the property tax base of that investment property for the child's life. Now, what a lot of parents do is they say, well, we still want to control the rental properties. We don't want to relinquish control, even though we're relinquishing majority ownership. And so what they'll do is they'll set up a limited liability company and issue member manager interests, where parents have the management rights over that investment or over that LLC that holds the real estate, and the children are just merely investors in that property or in that LLC that holds the real estate. And so it still gives the parents the control, even though on paper they're only a 49% owner. And now the real estate's been completely, the property tax base has been completely preserved inside that family LLC. All right. That works to preserve the property tax base, but it doesn't necessarily, or may not necessarily, be the best overall strategy. In other words, you win the battle with this, but you might lose the war, if you know what I'm saying. So, so next slide. And so this is what I'm referring to as the ugly. All right. So you may do that strategy and preserve your property tax base here. And so I've got kind of two columns here. So first one I want to go through is this Proposition 19 tax savings. So the effect of taking that $2 million property with its $800,000 tax base results in an annual tax savings, assuming a 1% property tax rate, of $12,000 annually. All right, because it would be reassessed up to $2 million under Prop 19. But if we go through and do the parent-child exclusion and preserve the old property tax base, we're saving $12,000 annually on that. But that comes with a cost, and the big cost here is, and this is why Kay, I believe, is going to add a lot of information on this, but just in general, overall estate planning is very important. And so we have something called stepped up basis. And so what happens is when one parents pass away and the children inherit the property at death, they get a step up in basis, meaning the tax basis they have in the property is equal to the fair value on the property of the parents passing. And so they could turn around and sell that property for zero gains. And that would essentially cost them no income taxes. But if you transfer property during a lifetime, you lose this ability for the children to inherit the property at death. And so you don't get what's called the step up in basis. And so my income tax surprise that a lot of people may not think about is if I had this fair market value of $2 million and parents had bought the property for 800, we'd have a 1.2 million taxable gain. And I've kind of broken out the rates here. The capital gain rates are 20%, but you have a 3.8% additional net investment income tax on the higher gains. And then you have, I'm just using a California rate at 10%. The max rate's a little over 13 in California right now. But and so at a total tax rate of 33.5%, that's $402,000 of taxes that the children were going to have to pay on selling this property. And when, in my opinion, to save $12,000 annually. And so I kind of computed a break-even analysis on this to say it would essentially take 33 and a half years for them to realize the savings of $12,000 a year that it would cost them in the taxes that they pay if they're going to sell the property during the children's lifetime. All right. Now, if the children are older, or let's say they're probably not going to survive, 33 and a half years, then they're under our current law would get a step up in basis, and then their children could inherit that property. And so that may be something to consider. The point of this is that it's sometimes hard to focus on just trying to save the property taxes with this planning, when you really have to look at more of a holistic approach and take into all your estate planning considerations. So, and these are conservative numbers. I'm not even considering what would be the annual, like Danae said, the 2% annual Prop 13 increases, future appreciation that, on the fair market value on holding that property during the children's life. And then we have a new administration that most likely will be increasing tax rates in the future. So the differences could even get even harsher. So anyway, with that, I think, Kay, do you want to mention, kind of talk through some basic estate planning principles that I think everyone should consider?
Absolutely. Thank you, Ken. That was a great presentation. Well, one of the things that I think is most important to do right now is to discuss with your children whether or not they will want to sell the property when you pass away, or if they're going to want to keep it long term. You've just given a great example about how, if we get caught in the weeds of this property tax increase, how we might lose sight of this very large capital gains that we would get with that step up in basis. So if they decide to sell, like you said, there's really no need to make any changes, because the major benefit to the children is going to be inheriting upon the death of their parents with the step up value. However, if the children will be retaining the residence, they must continue to live in the home, as you just said. And then the question becomes, and it's very unclear in the way this proposition was written, if there's one child has to live there, but if there's 5 children, do all 5 have to live there? That sounds ludicrous, but it's really not clear. And then they would get the carryover in the tax base. So these questions still need to be answered. There's the property, if it's going to be retained for rental or vacation or otherwise. Some attorneys are suggesting that we go into an irrevocable trust for the children, which might be a good option in the simplest case, where the parents set up and transfer property into an irrevocable trust. The first beneficiary is a child, And because the parents can't revoke it, it's a change in ownership at the moment of execution. So obviously, if this is done before the February 15th change, then this would be a good alternative. Prop 19 won't affect people who own property in corporations or LLCs, as your example gave, because they would play by different rules. And so that's going to be obviously an option if you have a lot of properties that you want to hold on to for an extended period of time. There is some speculation that this proposition might be unconstitutional because it does have so many moving parts, and typically propositions that amend the state constitution only have one or two parts. So right now we're looking at basically 5 for Prop 19. So there may be some future action, and we'll find out what the courts decide about that, I'm sure. So needless to say, the deadlines are fast approaching. And as of now, we are preparing to make changes and trying to get the word out to you through this wonderful experience with Danae and her audience. So thank you so much for that. And because every case is unique, we want you to know that we are not giving legal advice, but rather sharing this information that we have currently. So it's going to change, and we'll become more familiar and get more specifics as the time goes by. So if you have any specific questions, please contact your professional for more information. So thank you so much.
Thank you, Kay. I do have just one more question that came in. I believe it's for Ken, but either of you, if you can take this one. Ken, in the example where you gave 51% transfer to the kids, is there a taxable event on that 51% transfer?
Well, that could depend how you structure the transfer. It could be as a gift, which may or may not be a taxable event, depending on the size of your estate. And the size of the transfer, or you could have a sale transaction. As Kay mentioned, you can sell to a trust, and sometimes those aren't taxable. So it really could vary. It has a lot of flexibility in how you structure that transfer.
Awesome. Well, I think we definitely want to bring Jaril into the conversation because she does the insurance and it all kind of blends together. So Jaril, what's your thoughts on Prop 19 and how you can help facilitate these things?
I think it's the most basic in financial planning. It's basically the foundation of all financial planning, right? Especially with this unpredictability in our market, political and market volatility, right? So I think if you have the life insurance set up, you know that the life insurance contract is guaranteed to pay you tax-free income, fulfill your financial obligations. So once all of this is set up, where actually you're coordinating this estate planning with everyone involved, your CPA, your estate planning attorney, and this is the time to review your contracts. Your life insurance policy should be titled accordingly for your beneficiaries, and also make sure that it's enough to cover for your estate tax needs. So in the event of your demise, unfortunately, right? So when the death happens, the heir would end up with estate taxes. And so life insurance is a guarantee that will pay, and it's actually tax-free. So I think this is the best time to review them.
Yeah, it's so good because like Ken said, if you did get that $420,000 tax bill, I don't know how you're supposed to pay it. So maybe a phone call to you can help look at that scenario too. So
yeah, and then I mean, life insurance policy is not based on any market participation, right? It's guaranteed as far as if you set up a certain amount, that's what they would pay. As long as you're also paying your premium, it's an obligation that they will pay.
Sure. Well, I appreciate everyone's time. I think we've got all the questions answered. We are recording, so I will upload this to YouTube. And again, we're all local here in Orange County. If we can be of assistance or a resource to you guys, we appreciate your time and jumping on with us. And hope you all, maybe one last question. Let's see. And then we'll let everyone get back. One more question says, under the Prop 19, if you own the property with other siblings, can one transfer the full tax to a new property?
Well, we're not all jumping on that one.
That's a tough one, huh? That might be a one-on-one consultation. I don't know.
It could be, I think it might depend who, are we talking about residential property? Or are we talking about, a principal residence? Yeah. I don't.
Would it also depend too how you hold title, if it's in a trust or joint tenants or tenants in common, or I think there's probably a lot of different scenarios there.
I'm not sure how that's going to work out.
Yeah, and to be honest, maybe the answer isn't yet able to be researched. He's clarifying that it would be, it's currently a home address. It's just owned with multiple siblings.
And only one of them wants to take the tax base.
Yeah, they take.
So you're talking about a move, a 55 and over move.
Yeah, so can one of the siblings take the full tax to a new property? I think you have to sell off the other siblings' interest first. I don't want to guess because it's certainly beyond my expertise, but.
This is when life insurance comes in place. They would just pay off the siblings and they use the proceeds to purchase the property.
Well, our lady asking this question, I'll definitely make sure you have all of our contact info. I think that's almost more of a research and get back to you. But yes, it would be further clarification. She says it would be 55 and over move. And if it's in a trust, maybe they can stay there indefinitely. So yeah, lots of moving parts, but.
Exactly.
All right, well, it's 4:32. I hope you guys enjoy a walk on the beach, cocktail happy hour, whichever direction you're going. But I want you all to have a good afternoon. Appreciate everyone's time today. And if we can be a resource, reach out. Bye, guys.
Bye.
Bye. Thank you.
Thank you.